The long-awaited US rate rise has finally been delivered, as flagged many months ago. And while it was universally factored in, so shouldn't have surprised the markets, it was the subsequent lift in projected US rate rises in 2017 from 2 to 3 rate hikes, as per the dot plot chart, that got the markets moving, pushing longer-term rates higher and spawning US dollar buying across the board. What this chart shows is that more of the US Federal Reserve board members are acknowledging the need for higher US rates, which, as we flagged in our latest market update, is partly in response to Donald Trump's aggressive fiscal strategy. So this sets the theme for 2017, the prospect of rising US rates and inflation, fueling higher inflation around the globe, linked to rising commodity and energy prices. The impact of this here in Australia was a push lower in the Aussie dollar from above 75 cents to below 74, thanks to the stronger greenback, and a push higher in longer-term swap rates, which brings us to another suggestion we made in our last update, the need to consider locking in borrowing rates on any debt. It's not that rates will definitely rise next year, but more so that now it is plausible that rates may rise. So a conservative strategy may be to lock in 50% of debt and then consider the balance as 2017 pans out. This is despite the third quarter GDP growth coming in negative last week. So the economy did contract in quarter 3. But we continue to suggest that it is the global inflation outlook that will probably be the major macro theme next year, rather than domestic weakness, and even the risk of a recession here. The latest Australian jobs data was more encouraging than the GDP growth, coming in at an increase of 39,100 jobs in November. So while the unemployment rate edged higher to 5.7%, this was driven by a healthy increase in the participation rate, none of which screams RBA rate cuts. As a result, our forecast for the Aussie dollar going into 2017 is for the 72 to 78 cent band to remain intact. And while we'll be happy to go with any break of the 72 cent support level, we don't discount that it may break on the top side also. After all, our currency is still strengthening against most other currencies. Our ability to hang on to our AAA credit rating may be a key factor in this equation. This is our last market update for 2016, so ahead of our next update in the new year, we suggest keeping an eye on developments in equity markets, which are still strong despite the prospect of higher rates, with the US Dow closing in on the 20,000 mark, and also keep a close watch on the rebound in China, which, having struggled through September, has been bouncing back since. This, together with the path of commodity and energy prices, also promises to be one of the main themes of 2017, which will have the greatest influence on our economy and our markets. Until then, best wishes for Christmas and the holiday season.